Hello and welcome to the Business Standard Banking Show. Two small finance banks were listed on the exchanges in February. One was Jana Small Finance Bank, the other one was the Capital Small Finance Bank. Jana SFB has now announced its first quarterly result post the listings. It has posted almost 13% rise in its net profit to 135 crores in the October-December quarter. Ajay Kanwal is the MD and CEO of Jana SFB is here with us today to talk about the numbers and the bank's growth strategy going ahead. Mr. Kanwal, welcome to the show.
Thank you so much, Manojit, and I'm happy to be here.
Thank you. Jana SFB started operations in 2018. As on December 2023, the loan book was about 23,600 crore, while the deposits were about 20,700 crore, 800 crore. What is the medium-term growth strategy for the bank? I mean, where do you see the loans and deposits 3 years down the line?
Thanks. Thank you, Manojit. So first, let me start off by telling everyone that both me and the management team and the board in Jana are feeling very, very happy that our first results after the IPO were the best results ever that Jana has given. If you take our 9 months performance, Manojit, our deposit run rate is about 37.7% growth, 9 months. If you
Correct.
compare December last year, not 12 months, December last year to December this year.
Year-on-year
Our
growth.
asset growth rate is 27.7%. So two parts here. One is our deposit growth rate is running faster than assets, which is what I think everybody is talking about, the CD ratios in the industry.
I will come
And
to that in a minute. Yes.
correct. And
Yeah.
second is our asset growth is very strong. Now, what is not visible within the asset growth rate is the bigger portion is secured. So secured is running at about 40%, unsecured
Correct.
at 15%,
Correct.
which is the second decision in the industry of unsecured versus secured.
I will also
I
come to
think
that.
not
Yes.
only numbers, I think on both the key strategic parameters of how fast is your deposit growth rate, how fast is your secured growth rate, I think we've got a positive 9 months, I would say, and of course a December quarter. You should expect the bank to grow very strongly in the future also.
So overall business is close to 50,000 crore right now. Where do you see it in 2 years, 3 years down the line?
You take any multipliers in the 20s
Okay.
and fast forward it, and I'm saying 20s, I mean, it could be plus or minus, whatever. But listen, like I said, for us, the most pleasing piece, in addition to the CD ratio, in addition to the secured, was the gross NPA, net NPA. Our net
Right.
NPA is down to 0.7 now. And why I mentioned that, Manojit, is see, listen, we can grow at X% or Y%. But more importantly is to have good growth.
Correct.
And to us, that is more primary than growth by itself.
So the loan book is more than the deposit book, resulting in a CD ratio over 100%. When do you see this anomaly being corrected?
So I think one thing I want to tell you, is see, we are very liquid first. We've always carried anything like I remember 1,500 to 2,500 crore range surplus liquidity. So liquidity is not an issue. Now, the question is, if you have deposit less than asset, then how come you're liquid? The reason is we've got super refinance from three large government institutions. One is NABARD, one is SIDBI, and one is NHB.
Okay.
Now, because NHB does affordable housing, which we have a large book of, SIDBI does for MSME, which we've got a large book of, and NABARD does group loans to our agri rural customers, which we also have a large book of. So we've got stable lenders, long-term lenders. So even though ratio is coming down, it's now at 104 or 105 in December, we are very liquid because about 5,300 crores odd, Manojit, is borrowings from these three institutions. And which is
Okay.
why, but if I really try and collect cash too much too quickly, then I will end up with a slight negative carry cost.
Now let's me come to the asset side. 9,500 crore, over 9,500 crore of the loan book is unsecured. I presume it is mostly towards the micro loans. These are the micro loans. Gross NPA of the unsecured book is much higher, 3.8% as compared to the overall GNPA of 2.1%. Is there a plan to reduce the unsecured book? The unsecured book, as you said, is growing at 15%.
So, couple of things. See, when we began the bank, we were 100% unsecured. We are now down to 40% in the last 5.5 years. No, 5 years and 1 quarter extra on top. Okay. So, say 5 years and 9 months. The bank began in March 2018. So, zero has now become 60% or 59.5 to be precise, Manojit secured, and the balance is microfinance. Now, because that 15% is just for the last 9 months, but as you can imagine, in COVID, we were had negative growth also in 1 year.
Okay.
Yeah. So if you take the compounded growth rate of the bank between the day we began the bank till December, it'll roughly be about less than 3% of unsecured. So we've not been growing unsecured.
Okay.
So that's rule number one. For no other reason, if you take a customer's balance sheet, is largely secured. Yeah. All of us have our biggest loans are home loans. If you have a
Yes.
home, it will be a LAP loan. After that, it will be a car loan. Unlikely you and I will have, or most of our consumers largely should not have 80% unsecured loans, right? All of us will have.
Right.
So we will tend towards secured because we are serving the consumer, and we will get more and more secured as every passing year. So
Right.
that's the first thing. And that is for us because we are reflecting a customer's balance sheet.
Correct.
Now, unsecured, I don't want us to take away that, listen, we are feeling uncomfortable with unsecured. Our unsecured largely is microfinance. We have been in
Right.
microfinance for 16 years. And we all know that, microfinance in a good time, when I say good time, even in an average normal time, behaves very well. You get 99% collections. We are getting that today. It's only during stress moments, which we have seen, for example, COVID, which is completely, I think it's quite severe and steep.
Right.
Where people who don't have a lot of savings
Right.
tend to become delinquent here.
Right.
So
The
I must
problem.
say, while we have 9,500, as you mentioned, as unsecured book, it is something we understand as a business very well. We are comfortable with it. We are not growing it as fast because customer demand for secured is higher.
Also, it helps you to get 8% margin.
Of course, margins are good. And listen, margins are good because, there is a cost involved also.
Yeah.
You and
Correct.
I both know, microfinance.
Yeah.
We have one collector going out and meeting about 350 customers individually every
The
month.
operational costs are higher.
Correct,
Yes.
higher. And you need to keep a buffer because also for the risk cost, yeah. Because, while it means this year will be low risk, you take a weighted average over a cycle, it does come to 4-5%, yeah. So I think
Yeah,
in
yeah.
good times, you have to
In the
keep money
last
for the
10,
bank.
12 years, the microfinance sector has gone through various cycles. The Andhra Pradesh crisis, the Assam crisis, the COVID. So yes, yes. Now coming to the liabilities part, my question is on the CASA ratio. It's just 19%. Of course, there is much scope to improve. So what is your plan to improve the CASA ratio, and where do you see the ratio over the medium term?
So absolutely right. So Manojit, one is, listen, we are a 5 year and 9 months old bank.
Yeah.
And our CASA ratio when we become 8-year-old or 10-year-old or 15 will be much better because, CASA is normally supposed to be a stable, slow growth number. Unlike deposit where go after marketing, pay a good price, you get lots. CASA doesn't work like that. But
Hmm.
CASA is more transactional in nature. It's more longer term in nature. So it obviously ends up being slower. Our aim is to really grow it much harder. And that is a function of more branches, more relationship managers. And we have just launched our 2 segmental offers, exclusive at the top end, and second is premier. Normally, when you have segments offers, they tend to get more CASA. So we are focused on it, but we are also focused that, listen, growing it artificially is going to make sure that, and you will suddenly see a bad quarter and it'll drop. We don't want to build like that.
Okay.
Second, if I build too fast, it will also end up being highly expensive for the bank.
Right.
So I
Right.
think rather building in a very steady manner over the years, right? Because if you take large banks, large private sector banks, somebody's at 35%, somebody's at 40%. But listen, they've been existing for 30, 40 years. Yeah. They've been able to collect customers. The customers are increasing their savings. Their wealth is growing. So they've actually managed to grow their CASAs. So I think we should take a more evolutionary path to CASA.
So is there any number in your mind where you want to see your CASA as a 2 year or 3 year down the line?
Yeah, so I would like CASA to be like a 30% in the next 3 years.
Okay.
That's what we have said even in our several meetings. And so, which is why I said, between 2 to 3% growth each year would be a good, healthy growth, something that we can sustain and grow steadily.
You also have recently, raised money through an IPO. Post the fundraising, what is your capital adequacy ratio?
So I think if you add up everything, it crossed 20%.
Okay.
Yeah. So I think, and more importantly, so Manoj, two things. One is for investors, ROE now is at 20.5%. ROA is 1.7. On capital adequacy, out of this 20%, my tier two is only 1.5. Tier two can be
Yeah.
50% of tier one, which means I can raise
Correct.
10% more as tier two. So
Yes.
my
Yes.
bias is, as time passes, because interest rates a bit, with better results, with
Hmm.
interest rates softening a bit, we'll be able to raise a bit of tier two, and that I think will keep us very steady. So we don't see a immediate future capital raise coming in again, because we have
Right.
profit accretion. Like if you take our 9 months profit itself is 348 crores.
Yes.
Now you think that we raised capital in IPO 575 plus 348 already done, plus one more quarter to go. So I
Hmm.
think we have enough room in our profit margins to add to growth.
And finally, coming to the cost to income ratio, which is slightly higher on the higher side, 58%. In fact, it's actually gone up as compared to the same period last year, if you compare December with December. What is the reason of this high cost to income ratio? And when do you see it's coming down?
So I think 58.5% is a slight increase over last year at 56. Some investment certainly in growing the liability business.
Okay.
You can see a bit more advertising of Jana on the televisions. You can see a bit of increase in branches. We certainly have, as a branch staff goes up. So in a scheme of things in a small finance bank, at least certainly ours, the higher cost people are in the branches, because they
Okay.
tend to be obviously from other banks, and you obviously have to give a small incentive for them to leave their organization where they're doing well and come and join us. So we have seen a bit of staff cost escalation. We have seen a bit of increase in network, which is branches, by which I mean, which has caused a slight jump in
Cost to income
cost
ratio.
income. Nothing for us to feel very alarmed about. It's a natural thing. It'll, as we grow, because we are
Yes.
fully invested in digital, we have a good run rate. Cost income should sustain to much better levels.
Right. Right. Cost income will be easily managed. On that note, Mr. Kanwal, it was a pleasure talking to you as always. Thank you for speaking to Business Standard.
Always pleasure talking to you, Manojit. Thank you so much.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.